Welcome back, everyone. So, in our last lesson, we laid down the groundwork by covering the theoretical advisory framework. We figured out how to structure a client review and looked at how the revenue cycle varies across different business models. But today, we are stepping right out of that theory and jumping straight into a real-world training debrief. We're moving from the method to the reality and looking at exactly what happens when the revenue cycle starts to break down in the wild.
Okay, let's dive into this. On our agenda today, shifting our mindset from method to reality, defending against collection risks, fixing upstream billing failures, spotting critical dashboard red flags, and finally getting ready for process improvement.
Section 1. Method to real-world reality. It's time to shift our mindset from simply knowing the rules to actually diagnosing the reality on the ground. As business advisors and finance pros, understanding theoretical controls is great, but our real job? It's spotting the warning signs when a client's revenue cycle is actively breaking down right in front of us. Today, we're going to practice identifying the risk, figuring out the root cause, and executing the exact right advisory response.
Section 2. Defending against collection risks. Let's crack open our first group of client files, starting with Case A. Now, the situation here is incredibly common. A customer has passed their payment due date and crickets, no payment received. But I want you to notice the snowball effect here, the risk. This isn't just a simple calendar issue. A missed due date immediately bloats your accounts receivable. And as that AR just sits there, aging, it restricts cash flow, literally choking the operational oxygen out of the business.
So, the crucial point is, how do we respond? Treat these advisory actions as a strict containment playbook. Step 1, you've got to confirm that the standard collection cadence was actually followed. Did we even send the reminders? Step 2, figure out if this is an isolated slip-up or a behavioral pattern for this specific customer. Step 3, take action to stop the bleeding. Consider slapping a credit hold on the account or escalating it to management. And finally, if recovery is seriously looking doubtful, you must update the allowance for doubtful accounts to reflect reality. Moving over to Case C, we're looking at a situation that creates a very dangerous false sense of security. Here's the deal. Revenue has been recorded in the books, but there's serious uncertainty about whether the customer is actually going to pay. The risk here is completely invisible until it's too late. You've basically got potential bad debt just sitting on the books, making the company's financial position look way healthier than it actually is. A response plan here has to be swift. First up, evaluate the need for a doubtful debt allowance immediately, so the books reflect the true level of risk. Second, reassess that customer's credit status. Why are we so uncertain? Third, tighten up the payment terms for any future transactions. We absolutely have to protect the business from repeating this exact same mistake on the next order. And fourth, if this amount is material, flag it to management right away. Nobody likes surprises in finance. Section 3. Fixing upstream billing failures. Let's move to and see how this builds, because now we are shifting our focus from collection failures at the end of the line to upstream billing errors. Now, what's really interesting about this timeline is how clearly it maps out a classic SaaS billing failure. Look at this sequence. Step 1, a payment link is sent to a customer for the original amount. Step 2, a credit note is issued to that same customer. Step 3, the customer, who is totally unaware or maybe just clicking the first prompt they see, pays the original link. The risk? Over-collection occurs. The timeline is completely conflicting, and the left hand isn't talking to the right hand. When you spot this kind of sauce error happening, you have to urge immediate action. Step 1, cancel the existing payment link immediately. Stop the error before the customer even completes the transaction. Step 2, issue a revised invoice and send an updated link that actually reflects the credit note. Step 3, and actually this is super important, you must reconcile the account before the next billing cycle. Doing this prevents an absolute customer experience nightmare and saves your client from incredibly messy reconciliations later on. All right, bringing us to Case D. Honestly, this is one of the most silent but deadly issues for any client. The situation is painfully simple. Goods or services have been delivered, but no invoice was ever raised. The risk? Pure revenue leakage. The company did the hard work, they delivered the value, and then they simply forgot to ask for the money. You'd be shocked at how often this happens in fast-growing companies. Everyone is just so busy building the ship that they forget to sell tickets to get on it. The fix for this kind of revenue leakage is heavily systemic. You can't just tell your team, hey, try harder to remember to bill. It doesn't work. Step 1, you have to set up a billing trigger that is intrinsically linked to the delivery confirmation workflow. Step 2,
Automate this connection wherever the system allows so human error is completely removed from the equation. And step 3, implement a strict monthly review of work in progress or WIP balances to catch any unbilled items before they vanish from memory forever.
Section 4. Spotting critical red flags. Okay, so we've looked at isolated case files. Now let's zoom out to the macro level and look at the dashboard indicators that signal these exact breakdowns are happening system-wide. Think of these like the check engine lights on a car. If AR aging is increasing month over month without a good explanation, that's a direct sign that collection is breaking down. A high rate of credit notes, that suggests frequent adjustments after billing, meaning pricing errors or upstream process failures. Unapplied cash sitting on the books indicates a cash application breakdown. And look at that last one, manual overrides in billing. Workarounds suggest configuration problems or deliberately bypassed controls. This is exactly the kind of messy environment that causes those SaaS errors we just talked about back in Case B. And this brilliantly illustrates our next set of early warning signs. If you see late or missing invoices consistently happening after delivery, it causes major collection and timing delays. This points directly to the pure revenue leakage risk we saw in Case D. What about no collection escalation? If overdue accounts are just sitting there, it means there is no documented or enforced collection policy. Finally, large or growing write-offs clearly indicate that bad debt is increasing, usually due to inadequate credit assessment right at the start. Whenever you observe these flags, you must raise them with your clients immediately. Section 5. Preparing for process improvement. As we wrap up this explainer, it's absolutely crucial to understand that diagnosing these cases is really only half your job as an advisor. Think about what we've accomplished today. We spotted the red flags. We've applied advisory actions to contain the immediate risks. But ask yourself this: how do we permanently fix the root causes? Temporary advisory actions and quick fix playbooks aren't going to be enough if the underlying revenue cycle is fundamentally broken at a systemic level. And that is exactly where we are heading next. In our next explainer, the Process Improvement Playbook, we are going to take everything we diagnosed today and cover exactly how to permanently fix those problems and system gaps. We are going to turn these real-world breakdowns into structurally sound, automated processes. Until then, review these case studies, memorize those red flags, and I'll catch you in the next one.